Here's something that confuses a lot of people. Why do some businesses chase profit aggressively while others seems to burn money for years? Why does Amazon reinvest everything while a local restaurant try to maximize cash? Why do startups lose money intentionally while traditional businesses obsess over margin? The answer is simple but profound. Not all businesses have the same financial goals. And understanding this changes how you evaluate company, make investment and run your business. Let's break it down. Every business operates with financial goal in mind. Sometimes it's explicit, sometimes it's unconscious, but it's always there. And there are three primary financial goals that drive business decision. Goal 1. Profit maximization. This is what most people think business is about. Make as much money as possible, as quickly as possible. Cut costs, raise prices, maximize margin. This works well for mature and stable businesses. Think of a profitable restaurant, a consulting firm, or a small manufacturing unit. They are not trying to conquer the world, they are trying to generate cash today. Goal 2. Growth maximization. This is the opposite approach. Sacrifice short-term profit to capture market share, build infrastructure, and dominate the future. Think of Amazon in early 2000. Think Uber, think Geo. Those companies chose size over profit. And it worked because once you own the market, profit comes later. Goal 3. Survival. This is the most underrated goal. Sometimes the goal isn't to grow or maximize profit. It's simply to stay alive. This happens during crisis, downturns, or when a business is in transition. The focus shifts to cash, liquidity, and not running out of money. Airlines during COVID, survival mode. Startups running out of runways, survival mode. Business restructuring debt, survival mode. These three goals, profit, growth, survival, are not right or wrong. They are contextual. And the best businesses knows which goal to prioritize at which stage. Let's start with profit maximization. This is the traditional view of business. The idea is simple. Revenue minus cost is equal to profit. Maximize that number. Businesses focused on profit maximization do a few things constantly. First, they control cost aggressively. Every rupee spent is questioned. Do we really need this? Can we do it cheaper? Can we automate it? This is why profitable small businesses often feel lean. They are not bloated with unnecessary expenses. Second, they optimize pricing. They charge what the market will bear. Not too high that customers leave, not too low that margins disappear. Pricing becomes science, not guess. Third, they avoid risky investment. If something doesn't clearly generate profit, they don't do it. No speculative bet, no let's try this and see. Every investment needs a clear payback. When does profit maximization make sense? When the market is stable, when you are already established, when you don't need to fight for the market share, when you want to distribute earnings to owners or shareholders. Think of a family-owned business that's been around for 20 years. They are not trying to disrupt anyone. They are trying to extract maximum value from what they have built. And that's perfectly rational. But profit maximization has limits. If you only chase short-term profits, you stop investing in innovation. You stop adapting to change. And eventually, a competitor who thinks long-term will over-maneuver you. That's why profit maximization works, but only in the right context. Now, let's talk about growth. Because growth maximization often looks financially insane if you don't understand the strategy. Amazon lost money for years. Tesla was unprofitable for a decade. Uber, Swiggy, Zomato all burned billions. Why? Because they weren't optimizing for today's profit. They were optimizing for tomorrow's dominance. The growth maximization playbook works like this. Step 1. Capture market share at any cost, price aggressively, even below cost, acquire customer fast, outspend competitors. The goal is to become the default choice in your category. Step 2. Build infrastructure and scale. Invest in technology, supply chains and distribution networks. These investments don't generate profit immediately, but they create competitive modes that rivals can't replicate. Step 3. Lock in customers and network effects. Once you have scale, you have power. More customer attracts more supplier attracts more customer. This is why Amazon, Uber and Geo became near monopolies in their spaces. Step 4. Extract profit later. Once you dominate, you can raise prices, reduce discount and print money. The losses you took earlier become investment that compounded over time. When does growth maximization make sense? When the market is winner takes most. When the network effect exists, when the capital is cheap and investors are patient, when the long-term price is massive. But here's the risk. If you chase growth without ever reaching profitability, you die. WeWork is a cautionary tale. They grew fast, they burned cash, they never became profitable, and the market eventually stopped believing in the story. So growth maximization is powerful, but it requires extreme discipline and timing. Now, let's talk about the goal nobody wants but everyone faces at some point. Survival. This is when business isn't thinking about profit or growth. It's thinking, how do we make it through the next 6 months? What does survival mode look like? First, cash becomes everything. Profit doesn't matter, growth doesn't matter. The only question is, do we have enough cash to pay salaries, rent, and suppliers? Business in the survival mode often sell assets, delay investments, and negotiate with creditors. Second, you cut everything non-essential. Marketing paused, research and development frozen, expansion cancelled. You strip the business down to its core. Third, you focus on quick cash generation. You might offer discount to get immediate sales. You might chase smaller, faster deals instead of bigger, slower ones. You might even shut down unprofitable divisions. When does survival mode happens? During economic crisis, during pandemics, during cash flow crunches, when debt is due and revenue has collapsed, the key customer leaves or a majority expense hit unexpectedly. Airlines during COVID went into survival mode. Hospitality went into survival mode. Even large established companies faced this. Is survival mode bad? No, it's necessary. Because if you don't survive, nothing else matters. The business that made it through COVID weren't the ones chasing growth. They were the ones that conserved cash, recognized terms, and stayed liquid. Survival mode is temporary, but it's critical. And the businesses that recognize when to shift into survival mode are the ones that live and fight another day. Now let me add one more layer. Financial goals also depend on who you are optimizing for. There are two schools of thoughts. First one is shareholder primacy. This say the goal of business is to maximize shareholders' wealth. Shareholders own the company, they take the risk, they deserve the returns. This view dominated corporate America for decades, and it led to short-term profit focus, cost-cutting, and aggressive financial engineering. The second thought is stakeholders capitalism. This say the goal of the business is to create value for stakeholders. Shareholders, yes, but also employees, customers, suppliers, communities, and the environment. This view is gaining traction, especially among younger companies and conscious investors, and it led to long-term thinking, sustainable practices, and balanced trade-off. So among these two, which one is right? Both depending on the context. A publicly traded company with activist investor, shareholders' primacy might dominate. Founder-led company with a long-term vision, stakeholders thinking might prevail. The best businesses realize that stakeholder value and shareholders' value are not opposite. Happy employees are more productive. Loyal customers generate revenue. Stronger supplier relationship create resilience. Over the long term, taking care of stakeholders creates shareholder value. The conflict only exists when you optimize for short-term extraction instead of long-term creation. So, how do you know which goal to prioritize? Here's a simple framework. Startup phase, growth maximization. You need to scale, you need market share, profit can wait. Maturity phase, profit maximization. You captured your market, now extract value. Crisis phase, survival. Cash is king, nothing else matters until you stabilize. Innovation phase, back to growth. If your market is changing, you need to invest and adapt even if it hurts short-term profits. The best CEOs and founders know how to shift gears depending on where the business is. They don't rigidly stick to one goal, they adapt. So that's the reality of financial goals. Profit, growth, survival, each has its place. And the businesses that succeed long-term are the ones that know which goal to chase and when. In the next video, we'll dive into types of business finance, where money actually comes from. Internal versus external, short-term versus long-term. Because once you know your goal, the next question is, how do you fund it? Hit like if this made sense, subscribe for full series. See you in the next one.